economics. LOA 17 is about the aggregate output of the economy, the prices, their relationships and economic growth. So we are going to look at the GDP, gross domestic product, the final values and the value added, then nominal GDP versus real GDP, what is the deflator factor, how to compare income of an economy over the period. Then we look at what are the fundamental relationships. Then the IS, the investment savings and LM curve, which is about liquidity and money supply. Then we look at the aggregate supply curve in short run as well as long run. We will understand the phenomena of stagflation and how it can be tackled. Then we look at the sources of economic growth, the production function, and finally we look at the various components of economic growth. So let us start with GDP, gross domestic product. GDP is nothing but the market value of all final goods and services which are produced in a country or economy. So the important keyword is the final goods and service which are produced during that period. For example, if in an economy the convention is to count from April 1st to March 31st, so this is the period for which we are going to count and calculate GDP. So that is the period. So any goods or service which have been produced in this period should be counted. Then only goods that are valued in the market should be counted under GDP. There might be various services or goods which cannot be valued in the market. For example, the household work which is done cannot be valued in the market, so that need not be counted. Then we count only final goods and services. There might be certain intermediate products which are being sold in the market, but we cannot count that, otherwise that will amount to double counting. So either we can just count the value added at each stage, or we can just count the value of final goods or service. Then we also count the rental value for all kinds of housing, and if it is owner occupied, then we have to use the estimated rental value. So that is also a part of GDP. All the services which are provided by the government, they should be counted at the cost. Since the government is not charging anything for those services directly, for example, police service, fire service, etc., but the government is incurring a cost in the course of providing them. So for that, they have to be valued at the cost. But the transfers by the government should not be counted as a part of GDP. For example, if there is a subsidy which is provided by the government, if there is a scholarship, or if there is any kind of support provided to some underprivileged sections, those things are transfers from the government. They are not in return of any service or any product. So these transfers should not be counted as a part of GDP. Now let us look at various mechanisms for calculating GDP. There are two broad approaches. First is the income approach and the second is expenditure approach. As we can understand, in any transaction there are two parties. One is the buyer, another is seller, or one is service provider and another is service consumer. So one party's income is another party's expenditure. So we cannot count it twice. So either we use income approach or we use expenditure approach. So there are certain sectors under which income approach is better because those values are directly available. For other sectors, the expenditure approach might be more useful. Under income approach, we have earnings of all households plus the earnings of business and the earnings of government, and we add these three and get the total GDP. Using expenditure approach, we have the summation of the market values of all final goods and services which have been produced in the economy. This is one way when we are looking at just the final values, or another way of doing it is we are just looking at value added at each stage in the production process and we take all of those values. We'll take one example to differentiate between these two. Let us move to the next slide. This is the formula of GDP. GDP includes C, which is consumer spending, consumption spending. I is the investment made by the businesses, which includes capital equipments or any increase in the inventories. So any investment for raw material or machinery, etc., that is business investment. Then the government expenditures, and finally the net export. We call it X minus M or net X, net export, or we can say export minus import. So if we are exporting some certain goods or services outside the country, that is also part of GDP. But if we are importing, then that has to be subtracted from GDP. So X minus M is net export or export minus import. That is also part of GDP. Let us move to the next slide. Yeah, these are the two approaches. One is final value approach, another is value added. So under expenditure method, we can have either of these two. For example, we are producing certain goods. For that, the raw material and components are of $100. Then manufacturing takes $350 and that value is added. At the retail stage, some more value is added and now the price is $400. So if we look at the value added at each stage, first stage $100, second stage 350 minus 100, which is $250, third stage 400 minus 350, which is $50. So total value added is $400. Either we can take these three values and add them up to get the final value, or we can just take the final sales value at the retail level. So this final value captures the total value added at all the stages, or we can take the value at each stage which has been added. So either way we will get the same number. Actually, we use both of the approaches. In certain cases where the value added is easily available, we are going to use them. And some other cases where it is difficult to ascertain what kind of value has been added at which stage, we use the final value. Let us move further to other concepts. We are comparing nominal and real GDP. So what is a nominal GDP? This is sum of all current year goods and services at current year prices. So we have all the quantities for the current year and the prices which are prevailing in the market. And if we add everything up, we get the GDP, which is nominal GDP. So this is at today's prices. But as we know, the prices keep changing. And if we want to compare this GDP with previous ones, it will not give us a good picture. So we need to stabilize the price somehow. For that, we have another term called real GDP. Real GDP measures the increase in physical output. So we are concerned about the output, the quantity, and not so much about the price. Because GDP is in money terms, it may not reflect the production completely because of the price hike. So we have the concept of real GDP. Here we are using the sum of all current year's goods and services at base year prices. So we have a base year price. For example, in 2013, we might have base year as 2001. So we will use the quantity of today, but the base year of past. For example, if it is in this case 12 years old, it could be even 5-year-old. If base year is 5-year-old, we are going to use the price of that year. So whatever is the price at base year, that should be used. The quantity should be current quantity. So earlier we were using the current quantity and current price. Now we are using current quantity and base year's price. So on the basis of this value, we get GDP at base year prices. So real GDP is nothing but GDP at base year price. So that we will be able to compare across the years. If we are using the same price, then we will be able to compare them more clearly in terms of real GDP. There is one more related concept here, which is GDP deflator. GDP deflator will help us to put one particular number which can account for all the inflation, all the price change, price rise. So this is an economic metric which will account for inflation by converting the output measured at current prices into constant dollar GDP. So that is the conversion. It shows how much a change in base year's GDP relies upon the change in price level. So this will capture what rise is due to the price rise. So when we are looking at the real GDP, we need to compensate for the inflation part as we do there. So in this case, for example, for year T, if we are calculating GDP deflator, we will use price of a particular commodity, goods or service into quantity, both for period T, divided by price of base year into quantity of today. Or we can say this is the GDP at base year prices and this is the GDP at nominal prices. Nominal divided by real. That will give you the GDP deflator. 100 is to represent that in percentage. So it can be used to convert nominal GDP into real GDP. So it is nothing but nominal divided by real. It takes out the effect of changes in overall price level. That is the objective. And one thing which is important about GDP deflator is that it is based on actual mix of goods and services produced in the base period. Let us look at some more terms. We already know that gross domestic product is C plus I plus G plus X minus M. There is another way of representing it, the national income plus the capital consumption allowance, and then there could be a statistical discrepancy that should be accounted for. This capital consumption allowances, if there is a capital investment, suppose a machine has been bought for $10,000, it would depreciate every year. So this capital will be consumed over the period. So that has to be counted in GDP calculation, while in national income calculation, we do not count that kind of allowance. National income will include all the wages and benefits provided to the employees by their employers, then all the profits before taxes for the government and corporate enterprises, then all the income earned through the interest, then unincorporated business owners' income, then the rents for different properties. We also add the taxes and subtract the subsidies provided by the government so that we can get the true national income. Since at the consumer level the tax are paid and the subsidies are enjoyed, so they have to be considered here. Let us look at one more term, which is the personal income. Personal income is the income of individual. It includes the national income, and we are adding the transfer payments back to the households, because though they are not the part of national income, but they are the part of personal income. Because even if a pension or help or scholarship is provided to a citizen by the government, that will include in the personal income. We have added business taxes while calculation of national income. Now we have to subtract that as well. We subtract the corporate income tax and all the undistributed corporate profits to get the personal income, which will be available. Now there is one more related concept, which is personal disposable income. So what is the income which is available at disposal, or which an individual can spend? So personal disposable income will be equal to the personal income which we have just calculated minus the taxes which the person has to pay. So it is basically the after tax income, the income which is available for expenditure or saving. Now let us move forward and look at the basic relationship of these macroeconomic variables. We have already seen that the GDP or total income is equal to the consumption, then the investment, the government expenditures, and net export. So this is given in the same formula. Now in the same formula, if we subtract the taxes from both sides, I plus G plus X minus M, and then we are subtracting the taxes this side as well as this side, and this C is transferred to the left hand side. Now from income, if we subtract the taxes and the consumption, what do we get? Income minus taxes is the disposable income, minus consumption is the savings, that is S. So savings will be equal to I plus G minus T plus X minus M. So that is our relationship, savings, investment. G minus T is fiscal balance and X minus M is the trade balance. As we know, X is the export and M is the import. So export minus import is the trade balance. If it is positive, that indicates that we are exporting more than we are importing. So we have trade balance available with us and it is positively contributing to the GDP. Similarly, if we look at the fiscal balance, if G is greater than T, that means the government expenditure are more than the taxes. The income to the government is taxes, and if the government is earning more, then T will be higher. But if government is spending more, G is greater than T, that says it is a fiscal deficit. Government is spending more than the taxes which it is receiving. If G is less than T, that is fiscal surplus. Okay, so if this number is positive, G is greater than T, that represents the fiscal deficit. If it is negative, that represents the fiscal surplus. So overall, this equation has to be balanced, or we can say S minus I will be equal to G minus T plus X minus M. Or in other words, we can say that this G minus T, which is our fiscal deficit, it has to be funded by either X minus M, higher exports than imports, or the trade surplus, or there have to be a high savings in the economy. Income should be higher so that saving is more than investment. From this important relationship, we can look at further derived concepts of IS curve, LM curve. Let us start looking at them. Let us take investment savings curve first, IS curve, which is coming from the same relationship. We have already derived it. S minus I is equal to G minus T plus X minus M. This is our fiscal deficit. This is our trade balance. S minus I is the difference between the savings and the investment. So now let us take the case of higher income. When the income is high, the savings will be high as compared to investments. And when the income is high, automatically the taxes will be higher, which will actually reduce G minus T. Also, when the income is high, there is more spending power available in the domestic economy, then there will be more imports, higher imports. Higher import means lower X minus M. X is export, M is import. So this is the basic relationship on which we can derive the IS curve. So how do we derive it? We have already seen, if we increase the real aggregate income, the S minus I is going to be higher. There was a direct relationship between these two. So on y-axis we have S minus I or G minus T plus X minus M. So this curve shows S minus I versus real aggregate income. For higher incomes, S minus I is automatically higher. Now if we look at G minus T plus X minus M, for higher income this is going to be lower. We have already seen even this is lower because of the higher taxes and this is lower because of the higher imports. So for higher real aggregate income, this term is going to be lower. So there is an inverse relationship. For particular income, for example, y equal to y dash, for this particular income, s minus I is going to be equal to g minus t plus x minus m. Now that is our relationship. So for that particular income, these two are equal. This is our GDP for that particular point at which these two numbers are equal. Now let us see what happens when the interest rates changes and how do they impact the IS curve. Now here we have one value of g minus t plus x minus m, and we had one curve. For example, we had this is s minus I, but the interest rate, real interest rate are 7%. At that point in time, the income is this. Suppose this is y1. So income is y1 when the interest rate in the market is 7%. So these two curves are cutting at this particular point at y1 income. If we reduce the interest rate to 6%, we have another income y2 which is higher. The income is higher. So s minus I and this g minus t plus x minus m are cutting at this another point, and similarly they will cut at third point where it is income is y3 for lower interest rate. So we can clearly see if we reduce the interest rate in the market, the real aggregate income increases. For lower rates, higher income. So that can be represented by IS curve, where we have on y-axis we have real interest rates and on the x-axis we have real aggregate income. So we can clearly derive that for lower interest rates the income is higher. We can clearly see if these incomes are y1, y2, y3 and these rates are say r1, r2, r3. This is r1, this is r2 and this is r3. So automatically r1 is the highest and y3 is the highest. So when we are reducing the interest rate, the real aggregate income is going up. So that is the basic relationship which is coming from this curve. Now let us look at LM curve, which is about the liquidity and money supply. We know this relationship, MV is equal to P into Y, where P is the price level, Y is the real income, M is the money supply, and V is the velocity in transactions, velocity of money in transactions. So how fast the money is being circulated. Or we can write M divided by P is Y into 1 by V. So M by P is what? P is the price level, M is the money supply. So this becomes real money supply. M by P is our real money supply, and the M by P will be directly proportional to the income, as we can clearly see, and inversely proportional to the velocity. This is one relationship. Another important relationship is that this money supply, real money supply, is also a function of real rates and income. How? When the real rates go up, the quantity demanding for the money comes down. So if the interest rate is 8%, there will be less demand for capital. Suppose the real rate is 4%, then there is more demand. So this is relative. So if interest rate comes down, there will be more demand for capital, for money. Now if the income goes up, so there is a lot of money available, then also quantity demanded for the money goes up. So these are the two relationships from which we can derive the LM curve, which will be opposite of IS curve. So let us see. So here we can see the real interest rate versus real GDP. So actual LM curve is this, which is directly proportional, and for lower money supply the curve shifts upwards, for higher money supply it will shift downwards. So effectively we have opposite relationship in LM curve as compared to IS curve. Now based on that we can derive the aggregate demand curve. We have seen the similar curve in microeconomics, where we are talking about the individual quantity demanded for a particular product, the quantity demanded, and the price level of that particular commodity, where the relationship was like this. Now the similar concept can be extended to the macroeconomics, where we are talking about the real aggregate income, or we can also say the real output, right, or the GDP. And this side we have the price level at aggregate. So we are talking about the macroeconomy as a whole. So the relationship is similar. When the price is PA, higher price, the real economic output or the income is YA. When the price comes down, the income goes up, the demand for the products go up, so economic output goes up. If the price level comes down further, the income goes up further. So relationship is inverse. Now on the same lines, if we look at the supply curve at aggregate level, it will also reflect the same basic microeconomic concept. Even at macroeconomic level, there are slight differences. In microeconomics, this kind of supply curve, for a particular product, if the price goes up, the supply, the quantity which is supplied by the companies also go up. Because the price is high, they have more incentive to sell. More and more companies will join, and supply of that particular product will be higher at a higher price. Similarly, at aggregate level also, for a higher price level, the real aggregate income or the output by the companies is going to be high. So in short run, we have upward sloping curve or a direct relationship with the price. At a higher price, the supply will be more. But if you look at very short run, it will be very elastic. For a small change in the price level, there will be a large change in the output, quantity supply. So for very short run supply curve, the aggregate supply can change very quickly with the price, since the input quantities are fixed. They are not changing very fast in short term. Very short term. In short term, the input prices are fixed, so businesses can expand the real output when the price increases. So for a higher price, they can invest more and they can expand, they can increase the supply level. But if we talk about the long run supply curve, for long run aggregate supply, it is going to be constant, because it is already at the full employment level or potential real GDP. So when a particular economy is running at full employment level, it has already achieved the potential real GDP. So the output cannot be increased further at that level. So it is the long run aggregate supply curve. Beyond that, it cannot go. So even if the price level go up, the supply is not going to change. It remains constant. So it is inelastic. So for a large change in price level, there is very small or almost no change in the supply. So that is our long run average supply curve. Now let us look at the components. Let us look at the components of aggregate demand. It shows the relation between the price level and the real quantity of final goods and services, which is the real GDP demanded. So it is price versus GDP in terms of demand. The components are, these are the components. First is consumption, second is investment, third is government spending, and fourth is export minus import. So this is same as what we have seen in the case of GDP. When we look at the graph, we understand how it is equal to GDP. This is basically the aggregate demand in an economy at a particular price. So we can always say that if this is our aggregate demand curve at various prices, and this is our aggregate supply curve at various prices. So if they are cutting at this particular point, so this is our current price level and this is our income or GDP. So that is why at this point where aggregate demand is equal to aggregate supply, this point is equal to the real income or GDP. That is why we have seen the same formula while we were looking at GDP. Now let us understand the shifts in the aggregate demand and aggregate supply curve. So if because of some reason the aggregate demand curve itself shifts rightwards, so we can see what happens. If this was the case earlier, this was the economic output Y1 and the price was P1. If the curve shifts at the same price, we get the more output. The price level remains the same, but the output is more, or the same amount of output will be available even at a much higher price. So the curve itself is shifted rightwards. So what are the reasons that a curve can shift like this? First, when the wealth is increased, we have seen you will move on the curve of aggregate demand with respect to price. So when we are looking at, suppose this is the demand, this is the price. So when we are looking at aggregate demand curve, we are moving on the curve. That means we are looking at the impact of price on aggregate demand. But when we are talking about the shifts in the demand curve itself, we are looking at some other reasons which are changing the demand, not the price. So what are those reasons? First, increase in wealth. So the consumption will increase. So this is the first component of aggregate demand. Then there could be increase in the expectations for the economic growth. If people are expecting the higher economic growth, the consumption as well as the investment in the economy will increase. So that may increase the aggregate demand. If the capacity utilization by the industry is higher than 85%, then again the investment will increase. If the tax rates are increased, then what will happen? The disposable income available with the citizens come down, so that the consumption will come down. So for all first three cases, the shift was upwards like this. But here when we are increasing the tax rates, the demand curve will shift downwards like this. If the government spending is increased, G will increase. So again shift will be rightwards like the first case. G will increase, aggregate demand will increase. If the money supply is increased, the real interest rate will come down and investment as well as the consumption will go up. So shift again the rightward shift as in the first case. If the currency is depreciated, the exporters will become more competitive in the international market. As a result, the exports will increase and the importers will be discouraged. Imports will be decreased. Net export minus import will be increased. So net export minus import is our aggregate demand. So aggregate demand will go up and the shift is rightwards, upwards. And one more reason is growth of foreign GDP. If foreign GDPs are increasing, they will import more from our economy. So we'll be able to export more. Our net export minus import will increase and the aggregate demand will rise. There will be a rightward shift in the curve. So because of these reasons, there will be a rightward shift, and if the reasons are opposite, there will be a leftward shift in the aggregate demand. Now let us look at the shifts in aggregate supply. What happens? Suppose earlier this was the aggregate supply curve. At price P0, there was Y0 economic output, but suddenly supply curve shifts rightwards. So the companies will be able to produce more at the same price level. So the economic output will increase even at the same price level. So it will be very positive for an economy if they are able to produce more at the same price. So what could be the possible factors, the reasons which are shifting the aggregate supply curve rightwards? Factors that increase short-term aggregate supply curve. First, the decrease in the input prices. What could be the input price? The price of raw material for a company. If they are falling, the price of important commodities, if they are falling, that means it will be easy for the companies to produce at a lower price. That is why the more supply at the same price. So the curve shifts rightwards. If there are less taxes to be paid by the businesses, again the aggregate supply curve shifts rightwards. If the future expectations are improved in the economy, then also they will be able to supply more. They will add capacity and supply more. If the subsidies given to the businesses are increased in the economy, they will have incentive to produce more, supply more in the economy. The aggregate supply curve shift rightwards. And also if the currency appreciates, they will be able to import more and use that as an input in their production, and they will be able to supply more. So aggregate supply curve shift rightwards for all of these reasons. These are the reasons which work in short run. So they are for short run aggregate supply curve. Let us look at the long term reasons. So what are the factors or reasons that increase the long run average supply curve, which is the potential real GDP? This is the price level. This is the long run aggregate supply curve, which is horizontal. So this can shift rightwards. So what are the factors that can shift the potential real GDP itself? As we remember that potential real GDP was at full employment. But if there is an increase in labor supply, then it can shift rightwards. If there is an increase in the availability of natural resources, then also this potential real GDP or long run average supply curve can increase. If the human capital is improved or the quality of labor, the skill set of labor has been improved, that also will contribute to long run rightward shift in the aggregate supply. If the stock of physical capital has been increased, that also will contribute to rightward shift. If there are significant advances in technology, that will also contribute to long term shift in the aggregate supply curve. And finally, the productivity of the labor, that will also contribute in long term. Now let us move to the next slide. We are looking at the long run equilibrium. Suppose this is the supply curve, long run aggregate supply, this is our aggregate demand curve. So what happens? This is our potential real GDP. So if we are producing less, suppose we are at this point, we are producing less than the potential real GDP. We can clearly see that aggregate demand is less. That is why we are producing less. Aggregate demand is less, the supply is more. So this is a case of oversupply. If we are producing more than the potential real GDP, that says the demand is high, but we are not able to supply that much. Because of that, there is excess demand. So oversupply says demand is less and whatever supply is being made is higher than the demand. So it is a case of oversupply. Even though we are producing less than the potential real GDP, still it is oversupply. And in this case, though we are producing more than the real GDP, it is still less than what is demanded. So the demand is again more than the supply. So this is a case of excess demand. So there will be instability and it will automatically push to the equilibrium. This is the equilibrium point. It will be pushed either from left side or right side to that level. Now let us move to the short run equilibrium and readjustment.